Rising interest rates are a key economic force that can ripple through nearly every aspect of financial life. As central banks increase rates to combat inflation or stabilize the economy, the effects are felt far and wide, from the interest you pay on your credit cards to the monthly mortgage on your home. These rate hikes can make borrowing more expensive, affecting everything from purchasing a car to financing a personal loan. But the impact doesn't stop there. Higher interest rates can also lead to increased volatility in the stock market and slow down economic growth as consumers and businesses adjust their spending habits. On the flip side, savers might see a silver lining with improved returns on savings accounts and CDs. The overall picture is complex and often challenging to navigate. Understanding how these rising rates influence different financial products and the broader economy is crucial for making informed decisions, whether you're a consumer, investor, or business owner. In this analysis, we'll explore 7 key areas where rising interest rates will likely have the most significant impact. 1. Credit card debt. The cost of borrowing increases. As interest rates rise, the cost of borrowing money on credit cards escalates. Most credit cards have variable interest rates, meaning they are directly tied to the prime rate, which banks use as a benchmark for lending. When the central bank increases interest rates, the prime rate typically follows suit, causing credit card interest rates to climb. For consumers, this means that carrying a balance on a credit card becomes more expensive. Even small increases in interest rates can significantly impact the total interest paid over time. For instance, a cardholder with a $5,000 balance and a 20% interest rate would pay around $1,000 annually in interest. If the interest rate increases by just 1%, the annual interest cost could rise by $50, which compounds over time. As rates continue to rise, consumers may find it increasingly difficult to pay down their balances, leading to higher overall debt levels and financial strain. Additionally, higher interest rates can lead to reduced spending power for consumers. With more income being allocated to servicing credit card debt, there is less disposable income available for other expenses, which can have broader implications for the economy. 2. Mortgages, a more expensive path to homeownership. The housing market is particularly sensitive to changes in interest rates. When interest rates rise, the cost of borrowing for a mortgage also increases. This directly impacts monthly mortgage payments, making homeownership more expensive for new buyers and those looking to refinance their existing loans. For a typical 30-year fixed-rate mortgage, a 1% increase in interest rates can result in hundreds of dollars in additional monthly payments. For example, on a $300,000 mortgage, a rise from 3% to 4% in the interest rate could increase the monthly payment by approximately $150 to $200. Over the life of the loan, this can translate to tens of thousands of dollars in extra interest payments. Higher interest rates also tend to cool down the housing market. As borrowing costs rise, fewer people can afford to buy homes, leading to a potential decrease in demand. This could result in slower home price appreciation or even price declines in some markets. 3. Auto loans, driving costs higher. Auto loans, much like mortgages, are heavily influenced by interest rates. As rates rise, the cost of financing a vehicle increases, leading to higher monthly payments for consumers. This can affect both new and used car markets. For a $30,000 auto loan with a 5-year term, a 1% increase in interest rates could raise the monthly payment by about $15 to $20. While this might not seem like a large amount, it can add up over the life of the loan, making vehicles less affordable for many consumers. As a result, some buyers may opt for less expensive models or choose to buy used rather than new. The rising cost of auto loans can also have broader economic implications. If consumers delay purchasing vehicles due to higher borrowing costs, it could lead to a slowdown in auto sales, impacting manufacturers, dealerships, and related industries. 4. Personal loans, higher costs for unsecured borrowing. Personal loans, often used for consolidating debt, home improvements, or major purchases, are another area where rising interest rates have a significant impact. These loans are typically unsecured, meaning they do not require collateral, and as a result, they carry higher interest rates compared to secured loans like mortgages or auto loans. As interest rates rise, the cost of personal loans increases, making them less attractive for consumers. For example, a $10,000 personal loan with a 5-year term at 10% interest would result in monthly payments of around $212. If the interest rate increases to 12%, the monthly payment would rise to approximately $222. While this $10 difference may seem small, it adds up over the life of the loan, making borrowing more expensive. 5. Savings accounts and CDs, a silver lining for savers. While rising interest rates generally mean higher borrowing costs, they also offer a potential benefit for savers. Interest rates on savings accounts, certificates of deposit CDs, and other savings vehicles typically increase when overall interest rates rise. This can lead to higher returns on savings, which is good news for those looking to grow their wealth safely. For example, a savings account with a balance of $10,000 earning 0.5% interest would generate $50 in interest annually. If the interest rate rises to 1.5%, the same account would generate $150 in interest annually. Similarly, CDs, which are often used by those looking for a higher return in exchange for locking their money away for a set period, also benefit from rising rates. A one-year CD that previously offered a 1% return might now offer 2%, doubling the interest income for the saver. However, it's important to note that the increases in savings rates typically lag behind the increases in borrowing rates. Banks are often slower to pass on the benefits of higher rates to savers while they quickly adjust borrowing costs. Nonetheless, for those who prioritize saving, rising interest rates can be a welcome change, providing better returns on their deposits. 6. Stock market volatility. A challenge for investors. Rising interest rates can have a significant impact on the stock market, often leading to increased volatility. As rates rise, the cost of borrowing for companies increases, which can reduce corporate profits and lead to lower stock prices. Additionally, higher interest rates can make bonds and other fixed income investments more attractive relative to stocks, causing investors to shift their portfolios, further pressuring stock prices. For growth-oriented companies, particularly those in the technology sector that rely heavily on borrowing to finance expansion, rising interest rates can be especially challenging. 7. The broader economy, slower growth and higher costs. Beyond the direct impact on consumers and businesses, rising interest rates can have broader implications for the economy as a whole. Higher borrowing costs can lead to reduced consumer spending as individuals and businesses alike cut back on expenditures in response to the increased cost of credit. This slowdown in spending can result in slower economic growth, particularly in interest-sensitive sectors like housing, automobiles, and retail. Additionally, rising interest rates can increase the cost of servicing existing debt, both for individuals and for governments. As more income is allocated toward interest payments, less is available for other purposes, which can lead to reduced investment in areas like infrastructure, education, and healthcare. For governments, higher interest costs can exacerbate budget deficits, leading to potential cuts in public services or increased taxation to cover the shortfall. Finally, rising interest rates can also have global implications. For emerging markets, higher rates in developed economies can lead to capital outflows as investors seek higher returns elsewhere. This can result in currency depreciation, higher inflation, and economic instability in these countries, potentially leading to a global slowdown. Conclusion: as interest rates continue to rise, their impact will be felt across various financial landscapes, from the cost of borrowing to the volatility of markets. While savers might benefit from higher returns, the overall effect will likely be a mix of challenges and opportunities. Understanding these dynamics is essential for navigating the financial decisions ahead. Whether you're managing debt, considering a major purchase, or planning your investments, let us know in the comments what you think about how rising interest rates will impact credit cards, mortgages, more, and don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.